All right, 13th of November. I'm kind of settling after a few days of being gone. You hadn't seen crap from me because I was on the road, spending a lot of time in airplanes, bouncing around from Miami to Texas to Salt Lake, now in back in Missouri. So you're going to be seeing a couple of changes in the background over the next few days. But mainly this. That's what I was doing, pushing some of this. I was on some podcasts, some big ones actually. If you're familiar with Dan Fleischman, got to spend time with him. Got to spend time with Garrett White, which I'd never actually been around the guy, but we got to spend a lot of really quality time together. Went to an event that he was hosting. It was freaking awesome. And then Justin Colby's Science of Flipping and the Entrepreneur DNA podcast did that as well. So supposed to be at another one in Houston right now, but the way that things are working in the travel world, it didn't quite work out. So I had to redirect over to Missouri, and I'll go back and get that thing knocked out in Houston sometime in the near future. But phenomenal opportunities. Got to spend a lot of time with some very, very cool people. And what I have discovered, and I also have placed in here, you guys will find out when you read it, that we only leave this world with two things: relationships and experience. If you do not have those, you don't have shit. Seriously, you can have all the money in the world, but if you can't share time with people, you can't develop relationships, experiences with people, you don't have anything. You're not going to take anything with you. Now, I do understand that focusing on developing business, developing money, developing assets, that's important because that's going to help enhance the experiences that you can have so you can continue to enhance the relationships you have. But it's a matter of how you use it. So, and that's what we're talking about. How do we use the assets that we have, especially real estate investment assets? That's where I like to focus my energy on now. Does it mean I'm in anything else but that? No, I'm in crypto. I'm in precious metals. I have investments in other businesses, some stocks, and definitely real estate investments. And we've talked a lot about why you want to go into real estate investments. What we want to talk about right now is what's happening in the race. Now, we do have the vote is happening, getting the government back open. One of the things that had made a big dent in the world, is going to make a big dent, is the Fed Governor John Williams, as of yesterday, had said in his quote, Fed may resume asset purchases, as in buying treasuries and of course, MBSs. What is that known as? Is quantitative easing. The one thing that I said is the only reason rates will go back down. That's has been something we've been talking about. I've been saying, hey, expect this to happen. It's the only way they're going to crash the US dollar is to start quantitative easing again. We already know that Powell said they're going to stop quantitative tightening as of the beginning of next month. So all the backing off of buying assets, they're going to stop the process of not buying them. I guess I don't know how you call that, quantitative tightening. They should never have been buying the damn stuff to begin with. So now we're calling quantitative tightening is not buying those assets. Now they might resume buying those assets, which will have an effect on the markets and the interest rates. Now, if you're sitting here thinking, okay, it's confirmed. Chapman said it a few times. Now it looks like it's going to happen because Fed Williams is saying it, that they're going to start quantitative easing again. I'm going to wait and I'm going to buy houses when the rates go down. Stupid damn move, because when that happens, everybody else is going to jump in and going to push those prices up. So here's an interesting thought process. Interest rates will not help you get a cheaper house. What they will help you do is get a bit higher value on the asset. So if you're thinking I'm going to wait for that time because interest rates are so damned important to you, because you're so well programmed by the banking industry to think that interest rates are the most important thing, you waiting on that, you're going to pay 12%, 14, 15% more for that property. But how much is the average refinance? You're talking about $200,000 assets. The average refinance is probably somewhere in the range of about 2.5% of the value of the property to 3%, but it goes up by 12. Well, if you bought it now because you had to pay, say, 7% on that interest rate, and it bothers you and it's eating at you, let's say the interest rate dropped by 2 points down to 5%. Possible for real estate investment. I can't say that's going to do that. 5% doesn't entice me enough to do a refinance. But let's just say you have to have it because it's just eating at you. That inner David Ramsey and Susie Ormer are jumping on your shoulders, tearing at your earlobe, saying refinance, 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 because you're programmed so well in this and you've wired it so well into your brain. Well, but the property value went up by 12% because that monster drop. What's 12% of 200,000? Think about that. You're sitting now somewhere in the range of about $25,000, but your costs are only 2.5%. The increase in the value of the home will pay for the cost to do your refinance, so you get your feel good. So think about that. Don't hold back because rates may go down. Get it now, and if they do go down, you can use the equity of the property that is created at a thin freaking air to pay for your refinance. You get to feel better about life, and you can sleep easier. In reality, screwing yourself if you really want to be honest. So let's talk about what is happening in the market right now. we are looking at the mortgage-backed securities, as always, just so we see what's happening. And it's still been holding fairly flat, other than a little bit of that volatility that we've seen here and there. I got to move this stuff around so I can see it. So what we have is this middle line that I drawn some time back. We're bounced below it. We fought it. Now we're below. We actually have seen the rates go up quite a bit from the time that the Fed lowered the rate. So all of you who are holding out for the Fed to lower the rate, sorry guys, it did exactly as we had anticipated, which was opposite of what you were hoping for. And unfortunately, hope is not a solid business strategy. But it's one of those live and learn situations. When the Fed does what they do, we're going to experience that. So we have a 54% or 54-point adjustment, which is equivalent to about 0.5% in cost. Not significant, so it's not like you got hurt that bad. But it still doesn't change the fact interest rates did not go where you thought they'd be. Why would they not do that? One, we've shown over and over and over again, every time the Fed, here's what it is, every time you can see these bars, Fed lowered here, Fed lowered here, Fed lowered here, here, and here, it's always gone down. And when it's crawled back up, Fed lowers, bam, it goes down again, meaning interest rates go up. But we're also sitting at the peak of the value of the day they announced quantitative easing. Now, we're back into talking about quantitative easing, but the government shut down. Now that the government's starting to reopen, we're going to get a lot of backlog of data through the Bureau of Labor Statistics. That's my youngest grandkid giving her commentary, which is awesome. I'm not going to slow her down, but add her 2 cents. But what you have is more data is going to come out from the Bureau of Labor Statistics. One thing we do know that the Bureau of Labor Statistics has been traditionally guilty of is mislabeling shit and creating stuff out of thin air to make it look good for the administration. Now, we also know that they probably want to make things look bad for the current administration, depending on who's giving the data. So expect volatility. We're going to have a backlog of information coming to us from the time that the government shut down till now. And then the market's going to try and sort for that. A lot of emotion is going to flood into the market, and we're going to see a lot of seesawing before we settle things out. I think we've been pretty dang stable, comparatively speaking. When you look at all this volatility back here, we've been pretty stable, and the market's been able to hold its own quite well without government influence. Now we're going to look at more government influence. We're only going to have all this data come in that who knows how it's going to be cooked up, and there may be revisions in it. So you're going to get the data should have been released, then a revision, or maybe it's all going to be revised. I have no idea. I've not seen how this is going to play out, but I expect volatility. And then the promise of potential quantitative easing, we're going to see more volatility. So in reality, it's anybody's game going forward. I will stand on the one thing. If you find a deal that works, that you can keep reasonably rented the entire time you own it, you can raise rents, it'll appreciate, and you get the tax benefits, you got to close on it. But if it's something that you absolutely need to get a certain amount of cash flow, a certain rate to make it work, that's not a deal you need to be looking at. Don't waste your freaking time. If you want more details on that, reach out to me, aaronchapman.com. If you're building out entities, I got some really cool stuff to release here real soon. If you're doing your entities, I got something that's really going to save you. So we'll be talking about that in the coming weeks. But have yourself a hell of a day, and I'll talk to you probably Tuesday. It's Thursday, so no reason to record on Friday. Talk to you on Tuesday.